everyone, it is Evan here from the Trade Risk on Friday, March 27th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So finally, we had some stabilization this week in the stock market. The waterfall action lower has finally come to an end for now, as markets rebounded strongly across the board. So let's jump into our technicals dashboard here, take a look at what went on. Friday to finish out the week was a little bit tough. We did close down 3 to 4% across the board on Friday, but that did not spoil a very strongly positive week for the major indices. You can see double-digit gains in 3 of the 4 major indices here. Dow Jones posting one of the best weeks going back, I think prior to even 2008. I don't know if the specific stat off the top of my head, given where we closed, but it was a very strong week for the stock market. You can see we did start to rally back over the 10-period simple moving average across all the major indices. We are still below a 50 and a 200 period across the board. If we take a look at sector performance here, this is quite a different look than the past 4 weeks here. All green. This has basically been the inverse 4 weeks in a row running, but we had utilities at the top of the list, actually 16.4% massive move in utilities. Industrials number 2, semiconductors number 3. On the downside, we had staples, healthcare, biotech, all still firmly green, but on a relative basis underperforming the rest of the market. In terms of major markets, silver had a very strong snapback this week, up 16%, followed by S&P 500 in the top 3, and high yield, which has been a concern and closely watched area of the market, so to speak, in the past couple of weeks. Had a nice resurgence. On the downside, oil continues to have some difficulties. Some of that dollar strength had come out, and volatility unwinding just a little bit, not too much, especially given the magnitude of the move. We'll talk about that in just a moment. So that is the high-level overview. Let's jump into the charts here with the S&P 500. This is a weekly time frame chart, cash-settled market of the S&P. Now, we can see, first things first, on the week, very large range still. So, for the past 4 weeks or so, we've been in a very large range volatile market, and that hasn't changed. Even though the volatility came on the upside this week, we're still seeing very large ranges compared to historic levels. That the performance this week, good for 11.5% here in the S&P 500. First thing you'll notice is we did have a brief undercut, or we continued lower here at the very start of this week. You can see the tail down here where we probed all the way down to about 2191 was the ultimate low there for the S&P 500. We rejected those prices, we reversed higher, and then of course closed very strongly on the week. This is, depends how you want to define it, this is a bullish engulfing weekly candlestick. That's a very powerful pattern when it occurs on a weekly chart. Some people like to see the engulfing action, in other words, the open of the week, to be entirely below the lows, so including the wick. So again, we could get very specific about the definition here, but loosely defined here, this is a bullish engulfing week for the S&P 500, which is again a nice, powerful, constructive signal for the market as a whole. So what I want to do now is sort of break it into 2 camps here and talk about the bigger picture. So I would call it, maybe swing trading to position trading, longer term investors, trend followers. We're going to look at that analysis, and then we're going to look at the very short term, because as always, time frame is super important, and a lot of context gets lost here when we don't define time frame in analysis. And I see it over and over again, especially on Twitter, social media, and in videos, that, doing analysis and, thinking of a 12-month time horizon versus a day trader that's watching and only cares about the next week, those are two very different objectives and very different, considerations for what's going to happen in the market. So I'm going to try and broadly break it into two camps here. So we're going to start with sort of the long-term view of where we stand now after this week. So basically, when I look at this market from, again, swing trading and higher, so a multi-month at least perspective here, I would say that this is certainly a constructive, great step in the right direction for stabilizing this market. I see lots of people, basically saying the bottom's in, or is the bottom in, or trying to ask that question. I think it's way too early to even attempt to answer that question with anything more than a coin flip of a guess. It just seems after the shock that we just had to the market over the past 4 weeks, dropping 35%, that is still a very early and difficult question to answer whether or not this was the bottom. I think what we should be asking and just be looking for essentially now are signs that this market is continuing to stabilize. So what we're looking for here basically is, let's go to a daily chart now of the S&P 500. What we would want to see, or certainly what I would like to see, and the way I analyze markets, would be compression in ranges. I would like to see stabilization. I'd like to see these 5% daily moves to shrink down to 3% and 2% levels and start to get a more normal, sort of healthy market environment to kind of give us confidence that there are, we're back to sort of the regular, healthy, two-way trading and just stable markets where people are comfortable putting on risk, and there are just not such vomit-inducing swings in the market on an intraday basis. So what we want to see essentially are sort of more days like Friday here. So Friday was an inside day. Range here was the smallest that we've seen pretty much in like 5 weeks, right? Going all the way back to maybe this day here on the 6th. This was again, still a historically elevated range because we still had a move from low to high here of about 4%. And that's big for the S&P 500 on a historic basis. But that is at least better than, 6 and 7 and 8% days. So more shrinking of that range and really just seeing that compression, I think, is actually a good thing. And basically tied in with that is the VIX. The VIX here, we need to see come down further, right? We need to see more of the fear, less protection being put on here. A 64 VIX is still extremely high. So again, trying to ask if, or even claim that the bottom is in while the VIX is sitting at 64, I think is just way too early. I don't want to go as far and say is irresponsible, but I think you have to be careful here. And again, the VIX is really, again, a measure, certainly an indication of the range that's out there. So volatility can be to the upside as well. And that's why we're still seeing the VIX hold up here, even on large up days. But I still think you need to get that range down, get the volatility down. And I think those are good clues and good context to kind of navigate this market sort of going forward. So those are really the two big things: stabilization and lower range here. I think that is what's going to, prove that we are sort of through the worst of it. The longer and the better we can sort of move in that direction of markets cooling off and moving sideways, even if they don't go straight up, just moving sideways, up and down is fine, but just in a more controlled manner. I think that all moves us into a more stable, healthy market environment, and that's what I'd be looking for. Now, when we look here at the magnitude of this move, we've basically seen now about a 20%, almost exactly a 20% bounce off of the lows here. So the market, with a 3-day push that it had on Tuesday, Wednesday, Thursday, has covered quite a bit of ground here in the short term. So again, what we did for constructive action was essentially breaking this downtrend line. We broke through some short-term resistance here, so that was healthy, or again, nice constructive signs moving in the right direction. We broke the downtrend, took out some resistance here, and now after a 20% bounce, I would say, moving to the sort of short-term duration here, now the short-term outlook, I would say that you might want to be a little cautious now and at least not be so aggressive chasing a market that just rallied 20% in the context of a downtrend. So I think now is the time where if you were kind of nibbling in here, if you were being tactical in this area here, last Friday when we talked about some of the signs of stabilization, when we talked about some of these levels here, the 2364, 2380, 2440, if you were trying to be active in here and you're buying some of this improvement in here, maybe you scaled some out into strength. Again, this move looks small, but it still was a 10-15% move if you were buying in here. And so maybe you lock in some of those gains and you're being a little more cautious now. Maybe you've trailed up a stop and you're still, have some long positions in, but I think now is the time where the rubber meets the road and we're going to get the test and really the commitment now for buyers here, whether or not we can actually continue higher from here. So when we look here again at that weekly time frame, we basically stalled out right at last week's highs. We closed pretty much at last week's highs. I don't know if the S&P chart, yeah, so if I look at the SPY ETF here, you can see a little more cleanly because these are settled prices right now. You can see that we did sort of find resistance at last week's highs. If you recall from an earlier video, that was sort of the target or kind of the area that we were looking at to find some resistance initially, or the trade up to would be about last week's highs. You can see we briefly overshot it. We came back down and closed underneath it. So again, good constructive signs, but now I think the real test is here after a 20% rebound off the lows. Is there going to be continued commitment here? I think it gets a little more dicey hitting into next week now, and of course it's really just going to depend a lot on news flow at this point and seeing just how the virus essentially is what we're looking at here, how that continues to essentially spread slash become contained, and then obviously when are we going to get businesses back open again? Those are certainly the big variables I think that are driving a lot of the price action decisions, news flow right now. I think those are the things we could be thinking about or expecting to impact the market going forward. So that's kind of the short-term view here. I would again be a little more cautious now going forward as we start to ratchet back up into these areas up here. In the S&P 500. In fact, in our trade ideas on Wednesday, this was basically at last week's highs. Up to this zone up here is basically the spot where I think you could, even if you wanted to be very tactical, look at some short opportunities. So basically you would have gotten nearly filled here at the highs yesterday if you were starting to look at some short opportunities. Again, it's aggressive for experienced traders only, for short-term traders only, but I think that starts to make sense as you get 20-25%, anywhere from 15 to 25% off of the lows here. I think you start to at least consider flipping to the other side of the equation if you're short term, if you're active, and if that's your style. So I think that sort of covers most of the thought process here on the market as a whole. Again, time frame matters. Back to that first point there, time frame really does matter. So just know sort of where you live there and think about stabilization, continued stabilization for the long term. Short term, again, you can watch this trend here that we've been rallying from the past 4 days, essentially from the lows this week. If we start rolling over, if we start closing below a prior day's lows, if the inside day that we just put in here on Friday starts to resolve lower early on Monday, that might be your ticket to jump back into that short trade or initiate a short trade on the very short term. So, and again, let's keep in mind we still have this open gap here back from Tuesday of this week when we gapped up and we just continued to rally throughout the rest of the day. So we get this nice open gap here around 230. So that covers the S&P 500. If we look at the Russell 2000 here, again, it's going to be very similar comments. We talked about the Russell 2000 had a very tight kind of range here. It was leading to the downside. You kind of expect it to start to lead back to the upside, just in the terms of sort of risk on, risky stocks in the small cap universe, and especially banks and energy, which makes up a lot of IWM. You'd expect them to sort of lead. You saw that this week, and we see it just still holding above this general consolidation area. If we start to roll over next week back into this range, I think again you have to be cautious there, especially with the VIX still up at 65. Last but not least, Nasdaq 100. Similar comments here, had a resolve of this range higher here, particularly on Thursday. We put in this inside day on Friday here. And again, I think we just need to watch heading into next week how this inside day resolves. I think that'll dictate at least the short-term behavior of the market. So that I think covers all of the major happenings there in the market environment. Let's jump into some other assets here. So we'll look at bonds. TLT here continues to stabilize, continues to hold up, and it is in fact now closing back over this 166 level. This has been resistance here, essentially been where the market has continued to sort of hit its head against and fail. We did get a close over it on Friday. So TLT here on the week especially as well, up 5%, and now basically having the highest weekly close, all-time high weekly close here for the TLT. So that is constructive. Trend is up, lots of volatility in here, but the trend was saved and momentum is still continuing to be pent up here. So for now, bulls continue with it, and it is acting as safety haven through a 60 VIX, I guess. If we look at GLD, not quite the same, but still a very strong week for GLD. It was up 9%. So again, very strong week, breaking over 146. I think that was constructive. Remember, ranges here have been very wide as well. We got essentially a failure at resistance here. We got this big bearish engulfing bar. It shot us all the way back down to a support retest. It held, and then we launched higher off of that, and we're back towards the highs up here. So back to a daily chart here of the gold. It's holding this big open gap. It's kind of sitting in between this big trading range here. So I think ranges are pretty elevated right now. Still wouldn't be surprised to see a test of 158 here, a retest of those highs. But again, we'll need to see if that momentum can actually persist into next week. If we look at silver, silver also had a monster week here, 16% nearly to the upside. Remember, last week it was down 15%. So tremendous amount of volatility, historic amount of volatility in many places of the market still. Silver, no exception. It basically recovered all of the losses from last week. It's trading back over the multi-year support area around that $13 for silver. So if we look here now at the monthly chart of silver, it becomes quite a impressive looking, or just quite a loud range here. So from the highs of the month down to the lows of the month, about 33% range. And you can see now we have already rallied about 24% off of the lows here. So an extraordinary range. But if we were to look at the monthly chart, and if we can close up here, then it would be a hold of this support. So back, years from now, when we look at a silver chart here, be interesting to see how this ends up finishing out and what becomes of this. But we could see the big potential rejection down here, so long as it can continue to hold over that 13 area. So silver also making impressive moves. And if we go to energy, this is where we have a lot of weakness here. This is a monthly chart of USO. Take a look, down 52% just this month. The prior month it was down 12%. prior month before that was down 15%. So you can see in 3 months of trading, less than 3 months of trading from the highs to the lows here, we're talking about a 70% drop here, nearly 70% drop in USO. Truly stunning unwind here in prices of crude oil. If we go down to, say, a daily chart now, you can see basically getting a retest on Friday of the lows made on Wednesday. We'll see if this sticks. This is going to be an interesting spot to see if the bulls can find support here. We do have some positive momentum divergence up here, but again, USO is a pretty broken commodity right now. Tons of supply, I mean, just issues on all front, but in terms of price action here, still this trend is still very strong to the downside, and buyers have been absent here for multiple months, as we just saw. So careful, not for the faint of heart here, but certainly if you're a shorter term active trader that likes this volatility, then you know, it's paradise for you, just looking at the magnitude of the swings here in USO. Last but not least is natural gas. Natural gas, again, like we've talked about here, continues to essentially you know, be one of the few assets, commodities that are not you know, enjoying historically high ranges right now. Natural gas continues to kind of sleep around and just move sideways, very quiet, not doing a whole lot, and you know, the trend is still down here, so it still needs to prove itself, but at least there's some structure here that we can use. Good first steps over 1330, and as we've been talking about, the big goalpost, good breakout sign would be over about 15.25. So that covers all of the majors. Let's get into some sectors now, take a look at what worked and what didn't this week. So at the top of the list, like we mentioned here, let's just clean up some of these charts, is XLU. So XLU here on a weekly time frame, you can see was up 16%. It's got to be one of the biggest weeks really ever for utilities. I didn't run the numbers here, but it just, I've got to imagine this has to be one of the biggest weeks for it. You can see essentially though, you know, we didn't even take out last week's high. So again, it still goes to show you just how wide the ranges are. But again, if we zoom out here, you can see just undercut a lot of prior multi-year levels here. So it got below the 2018 lows. In fact, it got below the 2017 lows at the lows of this week, rejected that, closed higher here. So again, a very loud weekly candle, which does suggest that perhaps the worst, maybe this was some capitulation here, but again, it is still early to call that, but a good save there for XLU. It's a tough chase. The second best performer this week was XLI. Now, XLI, of course, was one of the most oversold, or one of the most beaten up sectors of the market. From high to low, XLI has fallen 44%. So this had nearly got cut in half here in a month worth of trading. So seeing a snapback here of 14% kind of makes sense. In fact, you know, you could still say that this could even bounce even further if you were to throw on retracements here. Even getting to a 50% retrace is still going to bring you up to around 60, the mid 60s, mid to upper 60s. So XLI still pretty damaged goods here. We're still below the 2019 pivot, so there really you know, really isn't a whole lot to like here in XLI, in my opinion. Good mean reversion snapback trade, but you know, a short-term trade, but I don't know that I would like to be so comfortable in XLI positioning. SMH was the top third best performer here. Now SMH, you can see again, just totally different than XLI. So take a look at XLI here. We're still well below the 2018 lows. We came all the way down to the 2014 to 2016 range. Take a look at SMH here, which didn't even get down to the 2018 lows. In fact, we only got and found support basically at the May of 2019 lows. So this year, just from a price structure perspective, certainly had lots of damage done over the past month of trading, but it is still holding the bulk of this range here. In fact, you could arguably call this pretty healthy looking, or at least just a retest of some prior significant support zones. So SMH coming back here, rebounding aggressively this week. Like this a lot more, again, just in terms of positioning from a longer term perspective than you know, either of the others we just looked at. Now on the downside, staples here were the worst performing this week, still firmly positive, still up 6%. And this is, so full disclosure, this is still a position that we have on. We own the XLP outright in our Merlin trading system. So we do still have exposure here and a position in this sector of the market. And so while it was the underperforming sector, it kind of makes sense because we basically had a risk-on trade, risk-on rally, risk-on mean reversion bounce this week. Staples are in the low beta camp, so it would make sense that they would be in the underperforming group. But again, if you look at this, where XLP is currently trading from where the sell-off started 4 weeks ago, it's still down, I think, the least out of any sector on a relative basis. So we're down only 17% from highs in the staples versus, say, semiconductors, which are currently down about 24.5% from the highs. So again, you got to keep, you got to keep the perspective and the relative percentages in mind. But certainly this week, in the underperforming camp, IBB was number 2 in terms of relative underperformers, still again in positive territory. Kind of came back down to the lower end of this range. There hasn't been any clean trend in IBB. This has been basically range bound for the past 3 years. It continues to be so. So there's no dominant trend to really speak of. And XLV did have that uptrend going, but it did certainly break a lot of price structure here. It did end up holding. So again, the 2018 lows here did briefly undercut them, but I think going forward, staying above $79, that's going to be important for healthcare. Not a horrible look to it. I think again around $80 or so. If you can get it back around that price, if support continues to hold around $80, I think it again would be good from a price structure to hold that area going forward. So that's it. That is the full recap for this week. A little more encouraging, a little more constructive action. That's great to see. Finally, the not even the bleeding, but just the waterfall has stopped to the downside. So we're going to look for continued signs of stabilization here to help us mark a bottom, or to help us be more confident putting on some long exposure. I still think there's tons of risk out there. You have to be very mindful of the outstanding risks, and with a VIX volatility index over 60 still, I think that tells you all you need to know about this market environment. So that's it from me. Thanks so much for tuning in and watching. Every Friday, you can catch these weekend recap videos on our YouTube channel or at thetraderisk.com. Have a great weekend, and we'll see you back here next week.